Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Tuesday. It is December 21st. We are getting really close to the holiday season. I'm actually leaving for Miami. I typically leave for Miami for Christmas. I'm leaving tomorrow, coming back, I believe, on Sunday or Monday. Not sure exactly, but I'll be broadcasting from there. You guys don't have anything to worry about. I'll be there every step of the way. Before I get too deep into this video, if you guys are getting value out of this, if you guys are getting some nooks and crannies to help you trade the market, if you're getting some wisdom out of this, let me know. I want to hear from you. Yesterday's video was 17 or 18 minutes. I want to make sure you guys are getting value out of it because I'm spending a lot of time and value doing them, and I want to make sure they're good for you. So please send me some feedback, good, the bad, the ugly. I don't care. I want to make the best videos for you. And I want to give you guys the best content and the most actionable content. So send me an email, support@marketgeeks.com. I really want to hear from you, especially during the holidays. I want to know how you guys are doing. Support@marketgeeks.com. So now let's get into it. It's about 8:09. The market's going to open up in about an hour and 21 minutes to be exact. As you can see here, we're having quite a reversal from what we saw yesterday. The Dow has overnight has almost taken back or corrected almost everything, maybe 100 points minus. The Nasdaq's up 191 points. The S&P's up 47. Shoot, even the Russell's up 27 points, which is substantial because the value here is only about 2,100 compared to 15,000 on the Nasdaq. As far as the bond market's concerned, the bond market's down 0.73. It was actually down yesterday, and it's down again today. It's near its neckline, and I believe the bond market is going to go lower because there's just no real indication that the Fed is going to do anything to keep rates low. It looks like rates are going to go higher, and if rates are going to go higher, that means bonds are going to go lower. In terms of the news today, the only news today we have is the Redbook. Now, this is a private report. It talks about retail sales. It gives us a private look at retail sales on an annual basis. This is store sales year to year. The expectation is 15.7. If the number is really good, it'll give us a good reflection of how consumer sentiment is going to do, how the GDP is going to do, consumer confidence and consumer sentiment. Because these two reports, consumer confidence and consumer sentiment, those are retail sales. Consumers buy things, and well, they don't sell things, they buy things. So most of these reports, consumer confidence, consumer sentiment, the Redbook, it's retail sales, and you guys already know what the number is for the year on the Redbook. It's not always accurate, but it's a good indication. Tomorrow we have GDP. That's the big report. Expect the market to be subdued. Second part of the day, especially the bond market. Investors don't like to make big bets ahead of the GDP. We're looking at 2.1%. If the number is below 2.1%, there's a good indication that the Fed will backpedal whether or not they're going to pull back the purchasing of bonds. That's really where we're at right now. If you look at the S&P 500, we're below the 50-day moving average, although I like this gap, and I think we're going to fill it in. Till we get 2 days complete clearance above, it's going to be twilight zone. If you look at the Dow Jones, which I will show you right now, we keyed off of the 200-day moving average, which is a really bullish sign. We're having a nice little, not divergence, but the RSI couldn't come near this level, which is positive. And if we can come back above the 50-day line, there's a good chance we're going to try to hit the high because markets, if retail sales numbers are positive, the markets tries to rally towards the end of the year. Looking at the QQQ, you will see that we are right below the 50-day moving average. I need to see 2 days like this, or actually 2 days like this, where we're completely above, where no part of it is touching below the line. That would be very positive. Now, looking at the percentage of stocks, this is all stocks in the entire stock market priced above $2. As you could see here, this looks like a bottoming out right here. It looks like a bottoming out. This is COVID right here. This is weekly data. This is COVID. Look, under normal circumstances, when we get to this level, to about the 20th level, 22nd level, and I'm not going to nickel and dime the number, somewhere between 20 and 25 percentile, it looks like we bottom out, and it looks like we bottomed out here. And if that's the case, the market looks like it can go higher. If you look at it on a further basis, even when it does come out here, and these are like when there's really nasty meltdowns in the market, like COVID, right here, typically doesn't go that low. Like here you could see it bottomed really quickly and then came back up, kind of like it looks right now. Also, on that note, put the call ratio is not really doing anything. It's just kind of not there. Volatility via VIX didn't really react yesterday. I mean, let me show you this spike yesterday. Not really a big spike. I mean, this is not a big spike for the market down 500-600 points as it was yesterday. So I'm not too bearish. And again, I like the fact that the percentage of stocks trading below the 50-day moving average is bottoming out on all stocks trading above $2. And if you look on a daily basis, it looks like it's bottoming out as well. This is on a daily basis. This is on a weekly basis. They both look the same way. Now, something you need to pay very, very close attention to, sectors. As I explained earlier, a month ago, 2 weeks ago, 3 weeks ago, a few days ago, we're having major sector rotation. As I showed you yesterday, let me just show you this again. People really like this heat map. This is a heat map. Look at the 1 month. Look at where strength has been going over a month. Utilities, consumer staples, utilities, insurance brokers, travelers. Remember we took profit on travelers? Well, electricity, utilities, large cap pharma, defensive. This all spells defensive. On a 5-day basis, staffing, COVID. People are getting worried about COVID. Large cap pharma, wireless communication. I don't know what the beverages here is doing, but it is consumer staples. Building, wireless, outsourcing. Again, staffing, outsourcing, fear of COVID right here. Biotech, insurance, computer networks, which I think is interesting because that hasn't really done anything in a while. But again, if COVID hits, people stay at home, they use more taxing on their networks. Again, utilities, financial. So again, there's not much speculative here outside of computer networks. Most of this is defensive. And if you look at the stock fetcher, which we look at every day, you will see that on a cumulative basis, utilities, consumer staples is above consumer discretionary. Material and industrial are fragmented right now. Industrial material, utilities, consumer staples are okay, but technology and consumer discretionary are all over the place. Now, you guys know that's a red light for fragmented market. And typically when fragmented markets, that means markets are down and they need to come back up. And I think that's where we're at right now. If you look at it on a 1 month basis, it looks even more defensive. Utilities, consumer staples, real estate, healthcare. Notice all that. So be very, very cautious on tech. Be very, very cautious on chip stocks right now. Be very, very cautious. They look at chips on a weekly basis. Look at this. Let me see if I can go further. Looks like we're breaking lower, and it looks like we're going to go down. And if you look at the SOX, it's telling us the same thing. Yeah, look at that, right there. And look at the nasty divergence. Up, down. So again, I'm starting to get a little bearish on tech. I know Micron. I know a lot of you are long Micron. Micron had earnings and the stock is up like crazy. As I said yesterday, the implied volatility was about 7%. It's up about 8%. I don't think it's going to rock and roll too much, and I think it's going to cool off with the rest of the chip stocks. Now, today is Tuesday. What do I give you guys on Tuesday? I give you the strongest sector, strongest stock, weakest sector, weakest stock. So if we go to our stock fetcher code and we organize we still have technology leading and we have communication services lagging. It seems like all of the stuff in between got mixed up, but tech seems to still be holding on by a thread. But it is holding on, and communication services are not looking good at all. So as far as tech stocks, the strongest tech stock right now is Arista Networks. I like this stock quite a bit. It's a network stock, and if COVID hits, network stocks are going to be rocking and rolling. I really like this stock, and it's making a swing high right now. It's ANET. Look for pullbacks. Look for a pullback to the 129 level. Maybe if we get one next couple of days, it may be a good buy. And for the sell side, nothing changed. Same thing. Fidelity National Information Services. I mean, look at this thing. It's bearish, and this has been on our weak stock list for quite some time, and I'm still pretty bearish on it. So the strongest stock, ANET. The weakest stock, FIS. That's what I've got for you today, but I've got something even more important. Today, I'm expecting consumer staples to rally and fill this gap. We may take a nice little 20-25% profit I'm also looking at NEE, energy stocks, to start coming back a little bit. They're a little down right now, but I think they're going to come back up and fill this gap to the upside. So that's kind of what I'm looking at today. Now, before I let you go, I've got something important for you. Folks, no one wants to work on Saturday and Sunday. We get it, although I sometimes work on Saturday and Sunday. Traders from Wall Street to home offices, they grind it out Monday through Friday, just waiting for the weekend. But, here's the secret. I've got a secret for you, just between us, all right? They're neglecting the fact that money may be up for grabs. That's right. And new Money Crew head trader Lance Ippolito, he's discovered a rinse and repeat plan that anyone with a cell phone and a brokerage account can take advantage of, even on a weekly basis. Folks, don't waste your weekends. Click on the link below, learn more. Lance has been on a roll. I mean, he has been squeezing out profits left and right. You got to check this out. Click the link below, learn all about Lance's new Money Crew, learn about his strategies. You guys are going to love this. Follow the link below, learn all about what he has in store for you. All you need is a cell phone, a brokerage account, and weekly basis profits. I love it. I really, really love it. Traders from Wall Street to home offices, just waiting for the weekends. You get in before the weekend, you get out on Monday. What could be better than that? I love it. I love it, love it, love it. Click on the link below and learn more. And as always, make sure to like this video. Subscribe to this channel if you're watching on YouTube. Stay ahead of the market. Stay ahead. Be the first to be notified when I post my next video. And send me some feedback. Support@marketgeeks.com. Tomorrow, I'm going to give you one long and one short trade. It's going to be Actionable Trade Wednesday. Send me emails. I want to hear from you before the end of the year. And I hope you guys are having a great, great holiday break. Don't let this volatility scare you. I think things are moving in the right direction, and I think we're seeing a major shakeout. Bye, guys.